Jon Favreau.
No, not Jon Favreau. Megan, do you remember? Who's the? I'm trying to make this a kind of a quiz show. Is Chris Pratt?
Oh yeah, he's a pitcher, right?
No, he ends up playing. He was a catcher who his arm was messed up, so he can't really throw the ball anymore, and they put him on first base.
Got it. That's right.
But he was always about getting on base. He was very crafty at getting on base.
I love it.
Hey, is it working?
Can you see us over there?
So it is
All
working.
Right, look at that.
So now I never can see what we look like.
Was Moneyball was that a plane watch? Was that like a when did you watch that?
I only watched half of it, and it was after I watched John Wick 4.
So you watched John Wick 4, and then
the
Moneyball.
Flight was only a 1.5 movie flight.
That's a diverse spectrum of movie watching. But didn't you tell me a story? There was like a lady around you that like you influenced her movie
I was worried I was offending her watching John Wick on my iPad, because I was streaming.
Some like gory stuff on there.
But here's something that's funny about flying Southwest, where every seat's first class, by the way.
Every seat. First class.
But they don't sponsor.
Not sponsored by Southwest.
They still let you see all the blood and gore, but they take out all the cuss words.
Well, that's kind of them. So the thing that can be offended to the other people watching that they can't hear the cuss words, but they can see.
But they can see the blood splatter. It was there. So I thought I was worried because she like when I walked up on the seat, and asked if I could join her row because she was reserving one seat. She goes, "Oh, I'm just saving the seat for my son." And then this big hulking man comes and
because you're thinking probably like a young like my son.
Yeah, he was probably 24, 25, but his biceps looked like my thighs.
That's awesome.
And but anyway, I was watching John Wick, worried I was really offending her, and then I look over on her phone and she's watching not the John Wick I'm watching, but like one of the earlier ones. And I was like, oh.
Did you lean over and say, "Hey, wait till you get to number 4"? It's a real doozy.
So I was happy to know I didn't upset the woman. I was about to say the older woman to my right, but heck, she's probably my age. That's not the greatest thing in the world.
I think it's funny. People asking, "Are we in the kitchen?"
Kitchen. I wish y'all could see a 360 view. Can we matrix this thing? Sticking with the Keanu Reeves reference there.
The cameraman said, "Absolutely not. 0%."
Megan, just get up and pick that thing and spin it around. Yeah, let everybody see where we are.
I'm pretty sure that if Megan did that, Reeby would tackle her.
We're in my office.
We are in a corner of Brian's office because I think Daniel, you mentioned this in the chat. We're having some stuff done that's right above the studio, so the studio's unavailable right now. So this is where we are because we recognize.
You just said something the vaguest way you probably. Here's the reality. We are trying to put a roof on the building. And while we were trying to put the roof on the building and we wanted to increase the R factor of the roof, they said you need a structural engineer to come look at the roof. So we're like, all right, this building's been here 100 years. What could happen? Structural engineer comes and goes, "Ooh, I don't like how that looks there." And where he said that happened to be where the studio is. So we're spending lots of money on something that will add zero value to the economic value of this business, and no one will ever see. But it disrupts the studio we were told 2 weeks because of the sprinkler systems. It's going to be at least 3 weeks, but we're working through it.
But we recognize the show must go on because we know that you guys want to still have your financial questions answered. You still want to be able to connect with this community because one of our favorite things on the planet is that every Tuesday we get to come hang out with you guys. We get to do this. So even though we're having to do it in a slightly different location, we're still planning on loading you guys up.
It is. It's 10:01. I was looking for the time. I didn't know where it was on
Max,
that.
Max, keep it at the top.
Can we do one fun thing, Megan? You hand me my phone. I'm going to take a picture that we'll post on social media later for what it looks like on the other side of it. And then we'll go up. Are y'all all trying to figure out how you hide under the table? Let's see. Maybe I won't post it because the content team might.
You said, and then we'll go live. And then we'll go live.
Huh? Do it the other way. Oh, because social media, we're not worried about 16:9 anymore. Well, now I can't get all of y'all.
So while Brian is doing this, we're going to be loading you up with questions. So right now we have the team out in the wings collecting your questions, and we want to load you up. Really,
yeah.
I don't
Look at this madness.
Is there anything special about today? Is there a special thing today? Reby says yes.
Hang on.
So today, since you
Hang on. I want everybody to see where we are.
Oh my gosh, Brian.
I'm coming back. Look, see, now y'all can see where we are. Okay, we're coming back. I messed up the shot, too. Hang on.
So what we plan on
All right, I'm back.
what we plan on doing today is loading you up. We want to answer your questions same way, normal Q&A style. And since you guys are so cool to be with us, even though we're in a different location, we are going to give away some tumblers today. Maybe you cool with that?
Quack, 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 quack.
Nailed it. Katie, you cool with
Hey,
that?
what does a tumbler look like? Do we even have one in here?
I have one right here. I keep
Oh,
all of my
beautiful.
beverages
Beautiful.
on set at all times.
So you're using it as a tumbler.
As a tumbler.
But if we put our drink inside there, it would be a koozie.
That's it. That's the way that it works. So we are excited to do that.
Oh, I didn't delete that. Okay, let's rock and roll.
You settled in? You ready?
Yeah.
Were any of us expecting that little thing? Not a chance.
Can't wait for y'all to see that video.
Can't wait. I can't wait to see that.
Money guy unhinged.
Money guy unhinged. All right, Brian.
Hey, I did the man on the street
In the middle of the live
live stream.
That's amazing. All right, you ready for the first question?
I am.
All right, here comes the first question. This is from Matt. This is a question that Matt had. Matt said, me and my husband are 32 and just bought our first home at 7.75%. We aren't high income, so we don't qualify for the mortgage interest deduction, meaning they're likely going to be standard deductors. According to the FU, anything over 5% is high interest debt. I don't know that that's necessarily the rule there.
That's a student loan rule.
So here's Matt's question. Should we forego our Roth IRAs and HSA to pay more on the house? It seems like a bad choice to turn down a guaranteed 7.75% rate of return by paying off our mortgage. And while Matt is the one who's asking this question and getting credit for the question, this is something a lot of people are asking us right now, because mortgages for home buyers right now are no longer in the 2.5%, 3.5%, 4.5% range. They are closer to the 6.5%, 7.5%, and even higher range. And so when we're thinking about being commanders of our army of dollar bills, and we think about the best use of those dollars, where do we put them? How do we send them? How should someone like Matt navigate this decision?
How old was Matt? Did he say?
32. 32,
so it was in his
married,
30s.
first home,
Gotcha.
and standard deductors.
So what Matt's alluding to, just in case, first time that you've ever come across the Money Guy Show,
what an episode.
financial order of operations.
What a first show to get introduced to.
Talking about high interest debt, step 3, because we do make the discussion about when we're talking about student loan debt, credit card debt, auto loan debt. What we typically don't consider high interest debt, though, is mortgage debt, because historically, mortgages have been much lower,
That's
as
right.
you've already referenced. We are in a very unique moment in time where, as Matt described for himself, 7.75%.
Which is painful. That stinks.
And usually I get to give myself a little grace by saying, look, it's a deductible interest. But as Matt has already clarified, he takes the standard deduction. So that doesn't. So he's truly paying 7.75.
Yep.
So does that mean we should just throw the entire financial order of operations?
Just stop at step 3 until we get it all
out the
done.
window? No. We've been here before. Let me give you guys some perspective. 1979 to 1982, inflation was rampant. They raised interest rates to try to get it under control. You could get cash, you could get fixed income, double digits. Just like, we're not double digits, but you can make,
got some
4
high
or
yields right
5% easily on your cash. Mortgages are, 7.75 as Matt is. So the rest of the part that you're not getting perspective is when you have unique moments in time. They also create unique opportunities in time. So I don't want to throw the financial order of operations out the window, because I understand that from 1979 to 1982, yes, while we were in double digits inflation and interest rates were on safe assets, we're paying that. There were years. There was of those 4 years, I think there was a 19% year, there was a 32% year, there was a 5% loss, but then there was also like a 20 something percent. So I mean, if you added up all that, what it gets back to is the risk premium was still there on investing for the long term. So somebody who's 32 years old like Matt, even though that interest rate is very high, you're going to likely, I have to give some disclaimer language there, likely have the opportunity to refinance into a much lower mortgage in the next few years. However, you will never, ever, ever have the opportunity to put that money for of the annual contribution into your Roth IRA, into those health savings accounts. I have my own tax-free back when I was starting my financial journey. And I'm just trying to help you, Matt. I don't love that answer because it's not super clean. We love the math. We love sharing those details, but there are unique situations that happen in the financial world where they're blip in time where it creates this weird thing, but it doesn't mean the system is broken. It's just a distortion.
So you're saying that the high interest rates right now are likely, no one knows this for sure, no one knows when it will change, but are likely a temporary problem, right?
I don't think the federal government can afford this.
There's a chance that interest rates will come down and you'll be able to refinance. However, and you just said this, if you do not put money into the Roth, if you do not take advantage of that, you can't go back in time. Now, obviously, you can convert and you can do that kind of stuff in the future, but you won't get those dollars as contributions in those years that you miss. So if there is a way to do that, I think it's okay to prioritize that. But we recognize that these mortgage rates, they're hard. It's painful for a lot of folks out there buying. And I love that even in the midst of having to get into your first home and having these less than ideal interest rates, you're still thinking about the long term. You're not just focused on today. You're thinking about building your financial future, which I think is awesome. Matt, that was a great question. If you would like a tumbler, I haven't done this in a while, Reeves. If you would like a tumbler, you can write Katie, Katie at moneyguy.com.
Very Tumblr worthy.
Yep. This next question, this is from Crystal. Crystal says, we have a 6.8% mortgage. Again, another person.
Got a trend going on.
And a 2.5% car loan, $20,000 left. Does that still make sense here? I think that Crystal's thinking about there's some arbitrage. 6.8% mortgage, 2.5% car loan. Our goal is to pay off the mortgage in 15 years. Our goal is to get the mortgage knocked off. Does it really make sense for us to prioritize that car loan if it's only 2.5%, or should we instead focus on the mortgage? Are those like is a 2.5% car loan and a 6.8% mortgage loan? Are they different? Like, do you think about those the same way, or do you think about those different?
I think you have to look at what's also behind each of these items. I mean, a car loan is a depreciating asset. You're in that you could be underwater, meaning if you got an accident. I know there's gap insurance. All you trolls that want to leave that comment, but there is the moment where you potentially could owe more than the car is worth. It's always a risk. And by the way, this is going to be something that probably is going to pick up because I think with high interest rates and high inflation, car prices have spiked up to where there's not a lot of inventory sitting out there. And I was just having some discussions with some friends this weekend that for a lot of trucks and SUVs, you're starting to see manufacturers come back out with 0% financing. So I think you're going to start seeing these unique opportunities where we're in a high interest rate environment, but you have very low interest rate opportunities because they're trying to clear inventory. I still don't think that just because somebody sprinkles a little bit of sugar on something, that should change your behavior from getting away from 23.8, because 23.8 is to protect you from buying more than you can actually afford and prioritizing the wrong thing in your financial life. A car is not going to build you into financial independence. Saving and investing for the future will. So that's why 23.8, if you remember, 20% down, don't finance longer than 3 years, and try to make sure that the payments don't exceed 8% of your income, with the caveats that you want your monthly investments exceeding what's your monthly payments. And this only works on pretty much entry-level cars. Think Corolla, not Land Cruiser, if you're working through this. But it is one of those things. So I would still, Crystal, I know the 6.8 hurts. As you heard from the previous question we had, You're actually sitting better than a lot of the people out there who are locking in mortgages at 7.75, even the crazy 8% that we've seen in the news media. But I think it's a moment in time. Stick to the financial order of operations. Get rid of the car debt because that stuff is not good for your financial life. You're going to have opportunities in the future on the mortgage debt to probably get it at a lower point. Still respect the financial order of
Yeah,
operations.
and Crystal, you did not mention if you are presently in a 30-year mortgage or a 15-year mortgage.
Yeah.
You said that your intent is to pay it off in 15 years. And I think that at 6.8% interest rates, that makes sense. You know, that when we came through the low interest rate environment of the last 10 years, we said a lot, hey, 30-year mortgages give you a lot of flexibility. It's okay to do 30-year mortgages. But as we begin to see differentials between 15-year mortgages and 30-year mortgages, it would not be surprising to see 15-year mortgages become much more attractive. The one thing that I would caution you on, though, is I want to make sure that you're constantly staying abreast of what the market environment is doing. Because while we love you being debt free and we love you getting that mortgage paid off, we do want to make sure that if rates do drop, that if you do have an opportunity to refinance, it's something that you take advantage of. And remember, oh, by the way, in addition to becoming debt free, I also need to make sure that I'm saving 25% for the future, building my army of dollars. You have to make sure that you're maximizing that step as well before you get super, super dialed into paying off the mortgage early. We see a lot of folks who get that out of whack. And the problem is that your money just does not work as hard for you 20 years, 15 years, 20 years in the future as it can today. So I think there has to be a healthy balance of both.
Yeah, that's why we like prepaying mortgages. It's kind of a post 45, a stay wealthy behavior. You have to first get wealthy, and that's why we do focus on paying down the debt on appreciating assets, making sure you're funding your Roth IRAs, your retirement accounts. Those are all get wealthy behaviors. There'll be plenty of time in your 40s and 50s to pay off that debt on appreciating assets.
Love it. Crystal, that's a great question. If you would like a tumbler, you can write Katie, Katie, at moneyguy.com. All right, Brian. This next question, this is from Logan Qualkenbush. This is his last name. I'm going to call him Logan.
I'm glad you threw that last name in there so you give it an attempt.
It was there. I wanted to do it. I'm 23 years old and I'm thinking about retirement. Good for you. There has been concern for the government getting rid of Social Security. Should I plan around it not being available? Hashtag ask Brian and Bo. I think a lot of people have this question because a lot of people have heard, especially if you're new to the financial world or you're new to financial planning and you start to read articles, you start to look at research. A lot of people talk about how much of an important impact Social Security has on the lives of current retirees. They hear about, oh, okay, well, this is a lot of people don't have pensions anymore. At least they still have Social Security that's coming in. But I'm nervous because I heard that maybe it's not as well funded as we thought that it was. Perhaps it's going to change. So for a young person, how should they approach thinking through that? Should they bank on Social Security being there, or should they plan for it not to be there at all, or is the answer somewhere in the middle?
Well, first of all, this isn't even rumors. If you go to Social Security's website, ssa.gov, somewhere on there, because I was looking at this probably less than a month ago, and it was on the viability and how secure Social Security is. Even on their own website, they give the year that the current funding status is going to be in jeopardy.
Won't be able to.
And I'm doing this off of memory. Daniel can correct me, or Megan can yell it out if we need to update it. But I remember it being around anybody who's under like 52 years of age was younger than the year that they're not going to take on benefits before that by the own Social Security's disclosure, they're essentially going to have to restructure. And they say, and the way they try to make you feel better about it, and once again, I'm doing this off memory, was don't worry, there'll still be enough to fund. I think it was in the 70%, 75, 76 percentile of the benefits. So you don't only have to worry about losing 20, a quarter of your benefits. So yes, I will go ahead and tell you, Logan, anybody who's young, who's 23 years of age, there might be some form, just because they know that there's a promise. This is a big political hot potato. So they'll do something to honor a promise, but nobody knows what that is. So you have to take this moment, and you're the right age where you have decades, for your army of dollars to grow in the background so that that's the gravy or the cherry on top of your ice cream sundae of retirement, because you're going to probably need to put the majority of that responsibility on your shoulders today. So don't go ahead and start building the plan. You have the exponential opportunity being a saver and investor in your 20s to make it happen. But anybody who's under 52, 53 years of age, because I haven't read that report in a month or so I'm probably a little fuzzy on the data. You also probably need to have a plan of action to ensure that your retirement has a built-in plan, assuming you are funding the majority of it.
Yeah, I was just gonna say that exact same thing for the folks that are a little bit older, that are a little bit closer to retirement. I still like the thought of not letting your assumptions about Social Security change your behavior today. Meaning, we want you to still save and build as though it was not there, because when that planning really becomes valuable is when you can start to see the runway. When you start to get within 4, 5, 6 years of retirement, you're beginning to think about, okay, what are my true retirement expenses going to be? And what are going to be the sources that I'll need to pay that? Well, then you start figuring, okay, where is Social Security and what's my specific number where I know that I've hit that to be able to get out of the workforce? Up until that point, we love doing all the planning as though it were not there, because that level of the granular planning really comes much later in the process. So even for folks who are in your 50 to 55 age range, you're not planning on retiring until 60 or 65, I think you can plan the same as a 23-year-old, not banking on it being there, but if it is there, you can use it. It's time for you to start thinking about the actual expenses you're going to have in retirement.
I also want to add one more motivator for Logan, is that I think in your 20s, it's noble that you're looking at Social Security, but truly you should go ahead and put your blinders on that, because saving in your 20s is the opportunity to own your time sooner than anyone else. I mean, maybe the only ones ahead of you are, a brand new baby born or a 15-year-old, but you are a tremendous head start watching this type of content. And remember, my own journey was, I thought when I started saving and investing for the future at 22, I was going to retire at 50. And I'm not retiring at 50, but I'll tell you what it does allow you to do. The sooner you can start saving and investing, the sooner you own your time. You're not obligated to work to pay the bills. You work because it brings you fulfillment. It brings you purpose, and you don't have to do that. So focus on starting right now so you own your time sooner, and then you get to do things because why you want, when you want, how you want, instead of under the cloud of, man, I've got to wake up to pay the bills, to work for the folks that are going to at least let me trade a portion of my time for labor that pays wages. The moment you get the clarity to get away from that, the better you will be, Logan. So I just say, don't let Social Security be some false sense to let you pull your foot off the accelerator to the detriment of your future self.
Love it. Logan, if you would like a tumbler, you can write Katie. You can write Katie, Katie, at moneyguy.com. Again, that's Katie, Katie, at moneyguy.com. All right. Is that good?
Well, I was just looking to see if Katie's reaction.
She's making sure I'm spelling it right.
Double spelling.
All right. This next question is from Wannabe Foo. Wannabe Foo. Given record high home values and the premium to own, what is the best strategy for a discouraged 28-year-old couple making $275,000 a year with $140,000 saved for a down payment in Dallas, Texas? Did we miss our chance? Man, there are so many people out there that feel like, especially folks in their mid-20s to mid-30s. I think that's the demographic where we see this. They've been trying so hard to get to home ownership, and the closer they get, the further it runs away from them. Either because interest rates keep going higher, so the cost of the monthly payment is too much, or home prices keep increasing. So I think a lot of people are feeling discouraged and disgruntled, wondering, am I ever going to own a home? Is this going to be something even attainable for me? Or am I destined to be a renter forever? What would you say to folks who are struggling through that mentality right now?
It's not a perfect example, but I can tell you, I graduated from college in the mid-90s. And I can remember I was so frustrated once I started making a good enough income to invest at dollar amounts beyond like $100 a month or whatever. I was like, man, it stinks that I missed all the 90s when stock markets made 28%, 23%. I mean, you had all these great performance. So
Life a lot easier.
there's all, and then, so I want to bring that back to what I mean by in terms of real estate is that as a person who's now older, you should know that cycles happen. And there's been enough times in my life, whether we're talking about the financial markets, whether we're talking about the stock market, where distortions, where unaffordability and the distortion between what rent people are paying versus what a mortgage on the same piece of property and the spread between that, it's not sustainable. There will be something that corrects. I mean, look, these interest rates, they're hurting a lot of markets. So you specifically asked about Dallas. I don't know the Dallas market. Location obviously has a big impact. Katie's husband does real estate. And we were even talking in our show meeting this morning, and we're like, is he still selling houses? And we're like, yeah, here in the area we live, there's still people moving here. He's still got closings, but that's not how it is everywhere. And I would tell you also take some solace in the fact that the first-time home purchaser age is 36 years of age. You're 28 years old with $275,000 of couple income coming in, household income. Wow. I mean, so your fear is going to be replaced with opportunity in the future. Bo sent me a link last night of Berkshire Hathaway right now is making billions of dollars off of just the
interest on the cash.
And if anybody knows, I want to give you the opportunity, wannabe, that you can be a baby Buffett. Is that what Warren does? He's done this for years, decades. He's made an entire career off of it. Is that he lies in wait for opportunity to be created. So if you will follow the financial order of operations, if you will do the prudent thing like you've done of building up a down payment fund, it's going to come your way. The market will come to you. You just have to be patient. Don't force it. And I think there will be an opportunity that you will not miss, that you'll even look back on and go, man, those guys are right.
And I think part of being a financial leader, this is hard for young people, is recognizing that just because things are one way today does not mean they'll always be that way. I think it was Ray Dalio who really popularized the idea around recency bias. We always assume the market that we just came through is going to be the market that we're about to go through, or the interest rates we just experienced are going to be the interest rates that we're going to experience. I think we all struggle with that. I think financial mutants probably do recognize that cycles are a thing and reversion to the mean is a thing, and that common sense is kind of a thing. I mean, I operate at it from this way. There is going to be a large demand for homes. There's going to be folks who need to and want to be in homes. But if home prices are so expensive and interest rates are so cumbersome that you just can't buy it, it's not going to be a supply. There's going to be a problem there that's going to have some sort of correction. I don't mean correction in terms of like a bad thing happening. I mean correction in terms of people are going to have to be able to have a way to get into home ownership. We just don't know how that'll happen or when that'll happen. We are confident, especially for our young folks, you're going to have an opportunity. It's just a matter of staying diligent from now until then.
I do want to give wannabe some actionable things they can do. We're financial mutants. So let me tell you, these are some of the things I've done when I'm looking for opportunities. I want you to use this time where we have a distortion in the marketplace to go ahead and prepare yourself by doing research. What do I mean by that? When I say do research and prepare yourself, is that go ahead and start watching to figure out how long are houses sitting on the market. Because there's data points you can go research on that. Go see how often, like when you go on sites, Zillow, Redfin, and others that are out there, how often are people updating their prices down versus, a while back they were increasing prices because there's so much demand. I think those type of things will let you get a feel for what the market is. And then I'd also use this time to start figuring out where do you actually want to buy. Hone that process in. Here's something an older person, myself, has learned through life. With $275,000 of income and at your age, you're going to have some tremendous opportunities come your way. But opportunities, when people say somebody's lean is that the opportunity came their way while the preparation that was done in the background happened to intersect at the exact right time that they were able to act on it. when you start looking at communities, start figuring out what neighborhoods have the school systems, have the locations, and all the features you want. So you can just be lying in wait to use this distortion period to actually fine tune your search. So you're not desperate. You're actually pre-planned how you're going to execute and be your baby Buffett to make the most out of every dollar. And that's also going to let you be an informed consumer, because you'll see distortions in per square foot prices, but you'll see prices coming down. You'll kind of know where the intersection of what you should pay. And once you pay, buy that primary residence that you love, don't look back. Who cares if prices keep going down? Who cares if prices go back up? Over the long term, as long as you're making the decision to be in that house for over 10 years, it'll all settle out in the wash in the long term.
Love it. That was a great question. Wannabe Foo, if you like a Tumblr, you can write Katie, Katie, at moneyguy.com. Do you want a compliment?
Oh, yeah.
I'll give a compliment. Ratty just said, I guess it's because it's a different setup or whatever. Said, hey, Brian looking super thin. Way to go.
Oh. Hopefully it means super thin, healthy. Not super thin, somebody feed that guy a sandwich.
What's wrong with Brian? No, it's
because we've all watched those things where you see the telethon's not the right thing because it's not like Jerry, but they're doing the fundraising things and they show all the poor kids and you're like, I sure hope that the camera crews
is helping them
out, that they just it's the same way with the animals. When they do that, you're like, please, I pray that whoever's filming this commercial helped that individual. So I'm hoping that was a compliment, not that you're hoping that somebody will hand me a sandwich so I can chow it down real quick and you guys know I'm all right and I'm getting nourishment. You see, I don't take compliments well.
Note to self.
I do not take compliments well.
Okay. Awesome.
It feels this self-deprecation comes from a real place. So you have to, it takes decades of honing that skill.
All right, you want to answer another question?
Sure.
Awesome. All right,
as long as it's not about my waistline.
This one is not going to be about your waistline. This one is from Gail. It is about your arms, though. You ready for this? Gail said, "ARM, adjustable rate mortgage, versus fixed in this high interest rate environment. 6.5% ARM rate versus 7.75% fixed rate with option of rates going down the next few years makes it very interesting. What do you think?" Well, for those of you who aren't familiar, when you go to get a mortgage, there are generally two types of interest rates you can apply to your mortgage. You can apply an adjustable rate that will move through time, or fixed rate. Most of us are familiar with fixed rate mortgages. I'm going to get a mortgage at this interest rate. I'm going to pay for it over a certain period of time, either 15 years, 30 years, or some other time frame. Adjustable rate mortgages might have some sort of fixed time period where they're fixed, but it's going to be much shorter. And then after some certain time, the rates are going to adjust to whatever market is. And so because there's additional risk inside of the adjustable rate mortgages, they tend to offer a lower interest rate. In this case, what Gail is telling us is that the difference is 6.5% to 7.75. I don't do public math, but that's like 1.25% difference. Are adjustable rate mortgages something that we should be considering in this housing environment? And if so, what are the risks and what are the pros, cons, and how would you approach that?
Well, first, let me give you guys a hot tip to help you out on this, and then I'm going to ask a quick question. We just did an FYI piece. Daniel and I were working on it last week. Is it out now? So if you go to moneyguy.com and go look at our posts, we actually have an entire analysis on adjustable rate versus fixed rates and the pros and cons of this, and so you can make the decision. Now, here's what I know, and I love picking on Bo.
Uh-oh.
I don't know if Bo's read this piece.
Oh,
so I wanted to get your take, because I know with Daniel
reader.
and I, because it's a hard thing. Everything that with housing right now and mortgage rates, it's not like, if we were 2.5%, 3% mortgages, it's like, yeah, do this, rock that, take advantage of this opportunity. But we're in this unique period of time where it's just not crystal clear on what to do. So I'm willing to defend what Daniel and I kind of worked on. But I'd love to put you on the spot. What do you think about adjustable versus fixed rate mortgages? What's Bo Hansen doing?
Well, whenever it comes to these kind of decisions, I like probabilistic risk analysis.
Yeah.
And this is what I mean. What I want to see is what are the probabilities of the outcomes that could manifest? Like, what would be a very positive outcome, and I want to assign a probability to that, and what would be a very negative outcome, and then I want to assign a probability to that. So I do my risk analysis. Well, then I do my cost benefit analysis. If I were to do this, what is the benefit that I would receive? So if I were going to do an adjustable rate mortgage versus a fixed rate, how much interest would I actually save over some time period, 1 year, 2 years, 3 years, 5 years, whatever that case is? Well, then I have to decide based on the dollar figure that I would save, size of the house, interest that I pay, is the risk that I would be taking on that this rate, we're all operating under the assumption, hey, I think that rates are going to go down. And so I'm going to, if rates go down and I have an adjustable rate mortgage, I'm going to lock in a fixed rate. If I have a fixed rate mortgage and rates go down, I'm gonna refinance to the lower rate. So you have these two options where rates go down. The thing you have to figure out is how much risk am I willing to take on if rates don't change? If this persists for any amount of time, and you have to recognize there is a problem, there is a chance that that happens, and then you have to figure, okay, what is my true risk exposure if that happens? Is the benefit I receive worth that? So I think it's a mathematical calculation based on how long I think I'm going to be in the house and those variables that I just laid out. So I don't know that it's like a it's certainly something I would investigate right now. I don't know that in every situation, circumstance, it's definitely one way or definitely the other.
You did great because that's what Daniel and I put together, and that's why I would encourage you once again. Go to moneyguy.com, look at the FY that we did on ARMs versus that. We actually put together, since it's so uncertain, what are the things you should do? What can you control? We always talk about reducing the noise, figure out what you can control, so you can make the best decision for your personal situation because it is a very personalized decision. How long you're going to live in the area, what's your income doing over the years. And then here's the parts that I do want you to measure on is when you look at ARMs, a lot of them, you have to look at the language of how long are they fixed? Is it 3 years? Is it 5 years? Is it 7 years? Is it 10 years? I mean, because you can see where the price difference is and see where you are making your guess on where rates will likely be much lower. But then also read the terms and the details because a lot of ARMs, adjustable rate mortgages, will have language that caps how fast they can go up. You know, they might only go up a certain percent per year to where when you look at it, you go, man, this actually opens my window longer that if the Fed keeps rates this high for this much longer, the ARM still works. But it also could bring it back to like, man, I do not want to get stuck in 3 years. The rates are still high and I'd forego getting that fixed rate mortgage because everybody I know here on the team, I'm going to quit saying their names so I don't embarrass them. We had somebody on the content team buy a house and they were very torn up about paying 6.5%. But then I know, did I get the rate right? So what was funny is that now that rates are 7.75 to 8%,
feels great.
I think she's like, yeah, I'm feeling pretty good about that 6.5% mortgage. So it is one of those things where it's a moment in time. Go see what variables you can control, and then make an informed decision. That's about the best you can do. And if you're trying to figure out how do you do this in a better way to know all those variables, like I said, go to moneyguy.com, check out the FYI, and you can see what Daniel put together, and then we fine tuned it.
I'll give you one other thing. If you are thinking about buying a home and you're thinking of, your mortgage is like one of the pieces of the home decision, we actually have a whole home buying checklist that you can go check out. Go to moneyguy.com/resources. We have a whole checklist that tells you not just as it relates to mortgages, but what are all the things I should think about before I make this huge life decision. So I'd encourage you to go check that out. That was a great question from Gail. Gail, if you'd like a template, you can write Katie, Katie, at moneyguy.com, and she would love to send one to you. All right, Brian, this next question, this is from Logan. Another Logan. This is not the previous.
It's not a double up.
Not double up. I got a car loan before learning the 23-8 rule. Here are the details. Remaining term, approximately 69 months. Remaining term. Loan amount, approximately $31,000. Interest rate, 3.95%. I'll pay an extra $50 a month. Should I just try and sell it? So this is a car. He doesn't say how much the car is worth. Like, I don't know what type of car, the value of the car, but I got a 69-month, 31,000, 3.95. There's some variables that I wish I knew from Logan. I wish I knew
His income.
I wish I knew his income. I wish I knew what the payment was, and I
What's
wish
the
I
market
knew
value?
the market value of the car. Because sometimes in these situations you can right the ship, right? Sometimes you can pay additional money and you can get it down to 3 years and it'll all fit. But sometimes when you do that, it blows up other areas of your financial life. And when it blows up the other areas of your financial life, make some tough decisions.
Yeah, I would actually, I'd put some numbers to that. Is that first of all, if you're sitting on additional cash, let's look at this several different ways. We talk about the rule of 23/8, 20% down. Don't finance longer than 3 years, which Logan is way beyond that, almost doubling it up. Speaking of doubling up, and then you don't want the payments to exceed 8% of your income. So Logan's got to do some. He's got to compare and contrast several things and do a math calculation. Because if he all of a sudden goes and he says, "Man, with $31,000 owed, if I want to have this paid off within that 3 years of when I bought the car, what is that amortization going to look like?" You can calculate what that is, and then say, "Does that exceed 8% of my income?" If the answer is yes, I will tell you when you're doing your T chart of pros versus cons, it's probably going to put a lot of checks in that pros of selling the car. Your way. So that's if you have the ability to kind of look at it and figure out if the payment, maybe you can boost your payments so it's paid off in three years. If that's not part because that exceeds 8%, then you can say, "Hey, do I have so much in reserves of cash that I can make a big lump sum to get that payment down to what truly paying it off in 3 years at 8% of my income is?" Those are the two levers you've got, Logan. Do you have enough cash to get this thing down, or do you have enough income to where the payment that's required to pay it off within that 36 months works? If neither of those works for you, you probably bought a car you truly couldn't afford. Because I'm also willing to go out on the limb and say, if you can't make it work because you don't have enough money in the bank to pay it down, or you don't have enough income to make it a much smaller percentage, then you're probably not loading up your Roth IRA. You're probably not maximizing your retirement account because you prioritize everything into this car, and that's got to be fixed. So the only way you can fix it is to get rid of it. And I hate to say that. Now, here's the good news. Talk about this with the team because Daniel and I got in a debate. We ought to put this stuff on camera sometimes. It's like, what about affordability of cars now? The good news, inventories are starting to build back up. You're starting to see incentives come from manufacturers as well as from dealerships. I think that you can go look at 23/8. This is not what it was 14, 15 months ago, where it looked like businesses like Carvana were the greatest things in the world because they had inventory and they were selling cars. Now you're realizing, yeah, there's a problem. Cars lose a lot of value very quickly. Inventory is building up because of interest rates. You could probably, it's going to be harder to get rid of your car, the bad decision, but I think you will be able to find something affordable because there's inventory building up on lots again.
And if it's a car you love, no one likes getting rid of something they like. I mean, even bad decisions. And one of the reasons we make bad decisions is because we made an impulsive decision around something that we thought we were going to like. I would encourage you to do this because Logan told me he's 30 years old.
Yeah.
30 years old, making a great income. I want you to go to moneyguy.com/resources and download our wealth multiplier. Do you have the thing?
Oh,
Do we give them
it? Hang on.
I want you to go download the wealth multiplier because what this shows is we're
On the front page. It's one of the pages though, because this thing is girthy. It's thick. We got lots of pages.
What this shows is that every dollar that you can deploy can be so valuable by the time you get to retirement. Every dollar for a 30-year-old can turn into $23 by the time you get to retirement. The way that I would think about that is every dollar I overpay for a car that I absolutely must not have costs me $23 in retirement. So if I'm buying that nicer or fancier or more luxurious or better model or fill in the blank car, even though I don't want to get rid of it, is it really worth 23 times what I've paid? Because that's what it's cutting out of my retirement. I think if you can think about the decisions you make through that framework and through that lens, it will give you some peace around, oh yeah, I got to sell the car. I got to get rid of this, getting something more affordable, get my dollars working. Agreed?
I completely agree.
Awesome. Logan, great question. If you'd like a Tumblr, you can write Katie, Katie, at moneyguy.com. Oh, this one says spicy. So that must mean team's got a good one for us. This is from
Sizzle.
the Wandering Dodo. The Wandering Dodo. My main car is paid off, but my hobby is cars. Would it be acceptable to get a luxury sports car that fits the 23/8 rule and subtract that monthly payment from my fun income? So let me break this down for you, Brian. This is a person, the Wandering Dodo, who's running a budget and they have discretionary spending.
Yeah.
Right? They have a discretionary spending amount they spend. They say, you know what I do? I don't have another car payment, so right now I got zeros in terms of what I'm paying. Can I buy a nice, fancy luxury car? Can I do 23/8? I'm going to put 20% down. I'm not going to finance it for any more than 36 months, and it's not going to exceed 8% of my gross income. And what that payment is, I'm just going to pull out of my fun money budget. I'm going to pull it out of my discretionary spend budget. Have I now hacked the system so that I can use 23/8 for a luxury automobile since it's a hobby and I'm a car guy? That's his question.
This is why it's great that we do these live streams with you guys, because we're like the instruction manual for the financial order of operations. We give you the clarifiers, all the data you need, because you guys are smart. And old Dodo there, he's trying to figure out loophole. He ought to be Loophole McGee.
There we go.
In the fact that he's trying to figure out, how do I get my luxury hobby to fit into some rule that I can then use mental accounting to say this works. Here's the problem. 23/8 is a bridge to reliable transportation so you can make it to your job. That's what it's meant for. It's not meant to facilitate spending more on a hobby. But here's the good news. That I want to give you complete permission to buy as nice of a luxury car that you can hobby with, show off with, go to the coffees and cars in your community and do all the things where you get to pop the trunk, talk about all the cool things you're doing to it. I guess with the hood.
Check out my trunk.
That's a step 8. Abundance goals or prepaid future expenses after you save and invested 25%. Because remember, we give you complete freedom. If you will focus on your financial foundation of steps 1 through 7 of the financial order of operations, when you get to step 8, that's where if you want to fund the kids' college, knock yourself out. If you want to go and you want to go on a luxury vacation, more power to you. And of course, if you want to go and buy a nicer car to kind of feel better about because you've funded all your goals and you want to celebrate, that's great. But what I'm hearing in Wondering Dodo's question was he's looking for a corner to cut so facilitate this hobby before it might not be financially feasible. Yep. He needs to clarify, has he reached step 8 by funding and saving into all of his retirement accounts and getting 25% of his gross income working for the future?
Yeah, I was going to say, if you're not saving 25% of your gross income, if you are not in step 7 or 8, unfortunately, and this is a little bit of cold water, unfortunately, the hobby that you are trying to pursue might be too expensive of a hobby for you at this stage of life. Now, there's nothing to say that you can't save up and build money and then buy the car with money that you save. But if that 23/8 is happening before the 25%, I think you're getting your order of operations out of whack. And I think, like you said, I think you're trying to fit a square peg into a round hole, maybe a little early.
And I do want to caution people because I get this all the time when we do any question about these cars. When people say I'm a car person, just because you yell that out, it's not a magical abracadabra, car person that lets you now circumvent all financial rules.
You're cool.
It's okay. It's your hobby and you're living your best. No, you have to be able to afford this hobby. I mean, I want to be a private jet person. I hadn't even ridden in a private jet before, but I want to be a private jet person. But no, you don't get to do that just because you aspire. You have to actually be able to afford things. You have to be able to do things. That's the problem with our consumer society. Is that we have built this thing where we say, hey, if you desire or have a passion for it, just go do it. And I'm all about that. Y'all know I'm all about that bedazzled basic life, make memories because they blossom. You only go have 1 decade in your 20s, 1 decade in your 30s, so make the most of it. But you better respect the fact that you're going to live to a ripe old age. So you better make some really good decisions in your 20s and 30s so that you can live the abundant life in your 40s, 50s, and beyond. because that's the thing that I think society is screwing up. Is they say, look, just go live your best life. I want you to live your best life, but I want you to do it in a sustainable way that actually pays dividends and lets your money work as hard, or even actually harder than you can, with your back, your brain, or your hands. And that's what the financial operations in your army of dollars will do for you.
Love it. Wandering Dodo, if you would like a tumbler, you can write Katie, Katie, at moneyguy.com. All right, Brian, let's do another question. This one, well, of course I'm going to pick this one. This is from Bizarro Bo.
Oh, wait a minute. Somebody's
Bizarro Bo.
Bizarro Brian's not the only one out there anymore.
Very clever.
It ought to be, but can I correct the record? If you want to do this game, because Bizarro, if you remember Super Friends, Superman had the counter of Bizarro as kind of the counter Superman. Bo is Robin. So you have to do the counter like Red Hood or something like that. You can't just play up. We've already just wanted to, maybe y'all aren't nerdy enough. You don't know all these things. I want to help out.
Bo is Robin.
If you want to go look at our dress up episodes, I do love that I got to dress up as Batman, and somehow I convinced Bo to wear Robin. But we'll keep going with the questions. Sorry.
Team player.
Okay.
Big team, little man.
Big team.
Big team, little man.
Big team.
All right, so Bizarro Bo said, as someone starting to go through the food, where do I stash my money that will be going towards my backdoor Roth? Is there a way to DCA, dollar cost average, with a backdoor Roth? Let me set the table here about what's going on. A lot of folks, that we love Roth IRAs. We love Roth dollars being built up. But the government also recognizes how valuable they are. And they say, hey, once you make over a certain income, you cannot put money directly into a Roth IRA. However, financial mutants out there figured out there was a backdoor way to get around that, a backdoor way to circumvent the income limit that exists for Roth IRAs by contributing to a non-deductible traditional IRA. Assuming you have no other IRA balances, you can convert that non-deductible contribution. It's a completely tax-free conversion. And what you've heard us say on the show is, hey, since it's a more complicated financial transaction, you probably want to do it once a year, and you probably want to wait till the year after, or you want to do it for the prior year so you know what your income was, so you kind of know if it's necessary or not. Well, Bizarro Bo said, hey, I kind of like to save on a monthly basis. And so I'm trying to figure out, I know that at least right now, the IRA contribution is $6,500. So I'm saving that divided by 12 each month. What do I do with that? Where do I put? Should I be dollar cost averaging into the backdoor Roth, or can I dollar cost average into the backdoor Roth? What say you?
Yeah, I love dollar cost averaging because it's just automatic for the people, set the behavior, create, make the good habits easy, make the bad habits hard, because if it's automatic, that money is being allocated, you can't go spend it. So it checks all the boxes on wealth building. So I can understand Bizarro Bo wanting to lean into that. The problem is that our tax system makes it more complicated, because if you were dollar cost averaging on your traditional IRA with the thought of then converting it later, any market value changes is going to be taxable income on the conversion. It just complicates it.
Very complicated.
Plus you have to go track down that data, because when they issue like the 1099-Rs and the 5498s and stuff, it makes it much more complicated on figuring that out. And your CPA is going to be like, what was the basis in this? You have to go full statements. Here's the easier reality. It's probably better to dollar cost average meeting into your taxable brokerage account, let it build up, and then in the fourth quarter, meaning the end of the year, or even the first quarter of the following year, you check out your income, make sure, hey, is this one that I can just fund directly into the Roth, or is this one where my income's high enough I need to go and do it the backdoor way? And then you can fund it all at once. You can then convert it all at once. And you can invest it all at once. I mean, it's just going to become, instead of your dollar cost averaging happening every month or every quarter, it's not going to be dollar cost averaging every year. It's still a systematic process to encourage the good habits and make them easy. But it's just going to take a few more steps. But that will protect you and minimize all the things that could actually go wrong in the process. And that's the part you're worried about, is the oopsies, that when you have to try to unwind them, they're not exactly the easiest things to fix.
And I'm sort of a lemonade out of lemon sort of guy. What's great right now, that's kind of a silver lining in this, is the interest rates are so high, right? Interest rates are like 5% for a lot of high yield money market accounts. If all you're doing is just dollar cost averaging your cash to let it's at least earning something. This was a much more painful endeavor for folks 3, 4, 5 years ago when cash was paying nothing. At least now, those contributions that you're waiting to do the backdoor on can be earning like 5%. So that's, I think, is a silver lining where you don't have to have quite so much anxiety around it. But it's also fantastic question. If you would like to Tumblr, you can write Katie, Katie at moneyguy.com. Guys, thank y'all so much for letting us do this. We love that we get to put this information together. We love that we get to answer your questions. And we love that even when we have unique things going on in our world, you guys still show up to check it out. That means more to us than you know. If you haven't checked out the website, go to moneyguy.com. Check it out. We have tons of free resources. You can go check out our courses at learn.moneyguy.com. We are going to keep putting out information for you so that you can take your finances to the next level.
Here's the thing I think is pretty spectacular is right now we have millions of unique people who are checking out the show on a monthly basis now. I mean, millions of you who are checking this out. So you're probably new to the process. There's a lot of you. Welcome. This is not the normal studio. You get to see behind the curtains a little bit. But I want to go to moneyguy.com. I mean, really, go check it out. And then go to moneyguy.com/resource. Download. Look at all the free stuff we have. We have this whole thing called the abundance cycle, where we're giving you so much free information. We want you to kind of learn, apply it to your financial life, and of course, if you have success, we'd love for you to consider reaching out to our wealth management business. But a lot of you, that might be something that's 10 years in the future. You're trying to figure out what can I do right now to really accelerate this. A unique thing we're doing right now is if you go to moneyguy.com/millionaire mission. I actually have a book coming out next May. It's going to really turbocharge your process of building wealth. If you've ever got any value out of any content, I'd encourage you, go check it out. Go to moneyguy.com/millionaire mission. Figure out how you can pre-order your copy today. And I just appreciate everything you do. This is one of the things we know. We talk about the army of dollars because I do want your money to work as hard and even harder than you can with your back, your brains, or your hands, because there is a better way to do money and respect the